Good morning, it's James Gerrish for another Market Matters video update, and today I'm joined by Peter O'Connor, Shaw and Partners, very well regarded resource analyst. He's actually #1 rated analyst in BHP, Rio, Alumina and Independence Group, so it's good to have his views here. Peter, we touched base about 7 months ago. We spoke mainly about BHP at that time. You made some pretty aggressive calls. You were the most bullish analyst in the market at that time. BHP was trading around $27. You had a 33 price target on it. Today it's trading around 31.50. It's obviously tracking well in line with your views. What's your take now? Is it a quick update? Are we still on track for that price
Still on
target?
track, James. If anything, the conviction is probably higher now for how it will play out this year. So that $35 target price that we mapped out last year, that's been bumped up from 33 last year, so it's now 35, and that looks very much on track. And we've still got our aspiration target of over $40 per share. That'll be driven by three things. Firstly, we're starting to get closer to a large and very, very large capital management initiative by BHP. So the process of divesting one of their businesses, their shale business in the US, that should be wrapped up around mid-year, about third quarter, and then to quote the CFO of the company, when they get the cash from that, which could be in excess of $10 billion US, that will not touch the sides of BHP, it'll come straight through to shareholders.
So they're not going to go out there and buy assets, they're going to pass it straight through to shareholders.
They don't need to deliver anymore, their balance sheet is in pretty good shape now, it's at the low end of their gearing range, and they want to give that cash back. So there's potentially a buyback or a special dividend or some form of capital management across the group of that size later this year, probably by the fourth quarter of this year.
So BHP maintaining the rage on
Absolutely.
BHP, 35 price target for 12 months' time. Rio, what's your take on Rio here? Buy, sell?
Rio still, it's in my buy bucket. I have 9 stocks in what I call the buy bucket. Stocks that are going higher have got the right tailwinds. Rio is one of those stocks. It's largely delivered what I see as part of its performance. So I still like it, I still see it going higher, but I see better opportunities in terms of maximum shareholder return over the next year by a couple of other names. At Rio, operationally doing well, deleveraging and capital management way ahead of the pack, both locally and globally. It's set the tone for that narrative. And also, they should keep delivering higher earnings and therefore higher dividends going forward. So I like it, and I'm still happy to be there, but I can see some better opportunities just a little bit further down the curve.
Not as high conviction as you are on BHP. So other opportunities, specifically in the iron ore space. What are Fortescue versus Rio? Bigger bang for buck in Fortescue. What's your view there?
Fortescue's not without risk. It's a single commodity play. Doesn't have that diversity that Rio has.
But does Rio actually have that much diversity these days?
Ironically, Rio's largely an iron ore company. So over the last 2 or 3 years, it's been somewhere between 50 and about 80% iron ore earnings. So it's almost a single commodity company in its own right. And given they've been selling a lot of assets lately, it's becoming more concentrated in the iron ore space. So it's still got a bit of diversity, and it's got that global reach as well. But Fortescue has been sold down of late and has been held back by the market because of concerns about a discount on the price they receive in China. We've talked a lot about this over the last 6 or 7 months, and that discount is a cyclical phenomenon, not a structural phenomenon, and that discount is starting to unwind. Slowly, but it's unwinding. And when it does, that's the tailwind Fortescue needs to get out of what I call the naughty corner that it's been in. It's been an underperformer in terms of share price, and it's been a deep discount in terms of value. That will change, and that gap will close quite markedly in the coming months as that unwinds. And that's why I see Fortescue as one of my best picks, albeit with risk, but it's one of the best picks out there. And it should be able to pay a pretty chunky dividend along the way as well, given their free cash flow.
Yeah, so just on that, so they paid a lower dividend than the market was expecting at the start of the year. They're obviously thinking that they're going to have a big second half skew. Is that on track?
Correct, it still is. So their dividend payout ratio is below 40% for the first half, but their full year target is 65 to 80%. So, sorry, 50 to 80% with an average of 65. So they'll pay a much higher dividend in the second half just to get into that range. So yes, we're still expecting a large number. Yes, the iron ore price has been supportive, and that should deliver that better dividend for the full year.
Okay, you're a man of conviction. I like that. We're also high conviction investors at Market Matters, and I want to get you. Fortescue, is that one of your high conviction calls? What else in the resource landscape, your resource coverage, that you're high conviction on at this stage?
Yes, the two have touched on BHP and Fortescue. They're two of my high conviction bets. It can sit within that buy bucket, but they're two that stand out. The third one that stands out today, because tactically it's very well placed and got a great tailwind, is Alumina Limited. It's benefited from tailwinds of alumina price over the last 2.5 years. The alumina price has gone up about 140% over 2.5 years. The equity's pretty much tracked that. But there's been a major dislocation in the alumina commodity market of late, with some capacity outage in Brazil. That will drive the price higher, which it has done so far, and stay high for potentially several quarters. That correlation to the underlying equity, Alumina Limited, will see the share price higher. It's currently trading close to its 52-week high, about 267, 270 per share. It's moving towards $3 plus per share. And looking at correlations of commodity price versus equity, a $3.50 number, as high as that seems today compared to the share price, is very, very likely in that period of time. So tailwinds drive equities higher. It's a very simple space, the commodity space. Share price follows commodity price. So that's one we see in the short term. Great balance sheet and a great ability to return capital as well. It's what they call a cash pass-through machine. Every dollar of cash they get, they give to shareholders.
So get your commodity calls right, and then you get your company calls right. It's a really good starting point.
I say it's easy, but it's not. So you get your top down right, get the global macro right, and that's still supported. This global synchronised outlook continues to play out, albeit it does look like it's peaking out, so we're watching that very closely. So we're alert, not alarmed, but we're alert at the moment. That's feeding through to commodity markets where there's been that tighter demand pulling through, but also supply issues. There hasn't been a lot of spend in commodities for quite a period of time. That's starting to see balances bite in the market, supply and demand balances moving into deficit, and prices moving high from nickel to aluminium to aluminum, I've just mentioned, copper as well, and even the bulk commodities. So that's supportive, and that gives me the conviction that earnings will move higher. And that's been the trend the last 6 or 7 months. The aggregate EPS upgrades across the sector is about 27%. And I don't see any reason why that won't continue into the second half of this year.
Okay, so we talked about BHP getting a lot of cash on their balance sheet, Rio's undergeared, cash on balance sheet, etc. So, is takeover opportunities out there? Are these miners going to go out there and look to acquire others? Is there targets potentially we should be looking at in Australia?
James, it's a really interesting question because at the point of the cycle where we're getting later in the cycle, so it's more mature, companies are getting cashed up, but it's worth just highlighting the context where we are at. The balance sheet of the sector is the best it has ever been, and I stress the best ever. 70%.
They normally go out there and make stupid acquisitions.
We've never had a mining sector with such good balance sheets. So 70% of the top 25 companies have net cash. That's extraordinary. And the ones that have net cash are the small to mid-cap guys. It's usually been the other way around where they've got the debt, the big-cap guys have got cash. At the moment, the big-cap companies are sitting on debt, albeit very low levels of debt and low gearing, so they have flexibility. But the mid-cap end has got a lot of cash. So it's 70% with net cash. And in line with that, they're also generating free cash every year. So this year's free cash will be 8% yield. Next year, 10%. After dividends, they've got about 6 to 8% free cash to play with. That's going to go back to special dividends, share buybacks, but it will also go to growth. At the moment, they're being very judicious, so it's going into drilling and exploration, it's going into small bolt-on acquisitions, but it will ultimately have to go to M&A. And I should take this a step further. It's not just an Australian phenomenon, it's a global mining phenomenon. And I think the issue of M&A will be inbound or cross-border, and it will come from overseas as we typically saw from North America, Europe. And that'll be companies trying to aggregate and add resources in the ground by buying companies that are already set up. So the value of equity is cheaper than the value to build. So there will be M&A out there.
Okay, targets in Australia. Any that spring to mind?
Yeah, the key targets, instead of just looking at names, is what would make a target. That's large scale, long life, low cost, expandable options, and they stand out in quite a few sectors. So in nickel, Independence Group. The Nova Nickel project is one of the best out there. That will be bought by somebody who wants to get a base load cornerstone nickel project for their portfolio. And it's
spin
got a
off
bunch
the
of other
gold.
assets. Spin off the gold, get some cash. It's well run, but arguably not as well run as the market would like at the moment. So there's an opportunity where this equity is probably discounting an operational outlook which is not as good as it could be. Nickel in the coal space, we're likely to see potential inbounds, more likely from Asia, China, where Whitehaven potentially could be at play. Well, that's a longer bow to draw given there's been a lot of activity lately.
It's been pretty competitive for Rio's assets, coal assets.
Correct, so there's been a lot of interest out there and a lot of unrequited buyers. So those buyers will be looking for assets and Whitehaven's well placed for that. Elsewhere, looking at the copper space. I never thought I would have said this, James, and now I'm saying it on TV, so it's locked in. But Oz Minerals, it's now a target. Why? Because it's got multi-decade life of a broad range of assets and a net cash balance sheet and the ability to fund all of their growth and still pay dividends. That company will appeal to somebody mid-cap, large-cap.
Reasonably big takeover.
Yeah, but offshore buyers, I think a North American or a European base metal company looking for growth, and one that stands out is a company called London Mining. As an example, they said just recently they would like to double their production of copper over the next 5 years. Not double their returns or double their profitability, just double their production. How do you do that? You buy a copper company that's large. So Oz is now potentially in the targets of overseas companies, so I see that as a target as well. And feeding through Alumina Limited, we've just mentioned it from a perspective of tailwind. They're the largest and lowest cost producer of alumina in the world, and the only pure liquid listed companies. So they're a target, be it Alcoa, their partner, a Chinese company, or somebody from offshore. So a range of targets, but again, the key portfolio there is large-scale, low-cost, expandable asset bases, which have been undervalued by the market.
All right, Peter, a great cross-section of companies in the resource space. As always, thanks for joining us. We'll speak to Peter again soon.
Thanks, James.